The government last month directed commercial banks to increase their minimum core capital from the current 1 billion shillings to 5 billion shillings by 2018. The government expects implementation of this directive to see a reduction in the number of banks from the current 43 to 30. National Treasury Cabinet Secretary Rotich says banks that would meet this threshold would be well capitalized to effectively compete for customers in a move that would help reduce interest rates on loans.
If we really truly want to bring down interest rates, and we have been talking about this for almost 2 decades, the solution lies on stronger big banks, which are able to lower the spreads and achieve, the lower interest rates that we are looking at.
The 5 of the big banks probably constitute of maybe 2/3 of the assets and liabilities of the banking sector, and so you're not having that much competition.
Increasing the minimum core capital is expected to see smaller banks merge to consolidate their operations. Rotich says those not willing to merge would be given the window to operate as microfinance institutions offering credit for SMEs.
We think that nobody will be left out. As banks consolidated, be able also to increase their capacity to lend to the economy.
On the weakening shilling, the CS says the widening current account deficit is as a result of the ongoing infrastructural projects. He says the government is managing its debt levels to cushion the shilling against further depreciating.
Obviously, we will be watching also how the fiscal performance is evolving, with a view to ensure that if there are huge expansion, we'll make sure that we can constrain that in a manner that the current account deficit does not widen.
Rotich, however, says that if the shilling weakens to unsustainable levels, the government would utilize the $750 million credit it received from IMF last year to support the local currency. Nicholas Nduati, News Hour Business.